Hello, everyone, and welcome. I will give you just a few moments to get settled, and then we will get started. Alrighty, looking good. Well, hello again, and thank you for joining us today. My name is Mai, and I will be one of your webinar hosts. We are at a new platform, so if you have not joined us in a while, we are using On24. In the middle of your screen, which is the largest screen labeled the slides box, this is where you will be able to view the presentation slides. And this is also where the CPE polling questions will appear. To the upper right-hand side in the related content box, you will see a PowerPoint handout link and other downloadable documents. On the left-hand side, you will see a questions box. Please feel free to ask any questions and add any comments to that questions box. We are offering CPE today, and in order to receive CPE credit, you must be registered and logged in under your own name and your own device. Group viewing will not count for CPE. You will need to stay connected to the webinar the entire time, and you will need to answer the CPE polling questions that appear in the slides box. You will see a earn certification box on the left-hand side, and it will tell you when you have met your CPE requirements. You will also be able to download your certificate from there at the end of the webinar. If you are Eide Bailly staff, please ignore that certificate, and your certificate and CPE credit will be added right into the Learning Center. And at the end of the webinar, you will see a survey that will appear. We will definitely appreciate if you give us your feedback after the webinar. And with that, I would like to introduce our first presenter today, Brett.
Thanks, Mai. And hello, everyone. Welcome again to the call. Today, we have the great benefit of hearing from Dr. John McDermott. As the chief investment strategist of our strategic partner, Symmetry, he's one of the key decision makers in managing our clients' assets. So we're really grateful to provide the opportunity for all of you to hear directly from him. And we're excited to talk about what the last year has entailed in the markets, as well as how it looks ahead. If you have questions, please enter them as we go along. We'll look to answer them at the end of the presentation, as many as we can get to. And before we do that, John, could you just give us a recap of the Eide Wealth and Symmetry investment philosophy?
Sure. Hi, Brett. Hi, everyone. Thanks for having me here today. It's always a pleasure to speak with the team at Eide Bailly, especially about investments. So today's economic and market update, we're going to begin with a little refresher on how Symmetry and our partner Eide Bailly view the investment process and view investing in general. So first and foremost, we invest based on evidence. And much of the evidence about investing comes from the world of academia, starting with Adam Smith and the Wealth of Nations, all the way through the present with our partner Cliff Asness at AQR and Andrew Ng at iShares. These economists, financial economists, have studied stock prices and studied stock markets. And from their work, we're able to glean some important insights about investing. So we'll have our first CPE polling question. Go ahead, Brett.
Yeah, thanks, John. So give you a polling question right up front and ask, how familiar are you with factor-based investing? We'll have a few more slides on this, so we'll give you a moment to answer. But we feel it always helps to just give a real brief recap on the philosophy we use, how and what evidence-based investing means, and how the factors are involved in the investment strategies that we create based on that research and evidence, as John showed from decades past and continuing on through today.
Okay, everyone, we do have our first CPE polling question up. If you are here for CPE, please make sure you are answering these polling questions. You will click right on the screen, A, B, C, or D. Please make sure your slides box is maximized so you're able to see the questions. After you make your selection, you will scroll down just a bit and hit submit. Please make sure you are clicking submit after each selection. Alrighty, and here are your results.
So there you go. That's why we do the recap. Looks like about 70% of the people say not at all. Another good slug of you say somewhat. So happy to cover that briefly now.
Sure. Thanks for that. It's a helpful polling question. So factor-based investing, I'll talk in general about a factor, because this is, whether you're a factor-based investor or not, the notion of how does a risk premium arise is an important concept for investors to be able to conceptualize. So let's take, for example, the most relevant risk factor, which I'll call the equity risk premium, or the just the market factor. And consider this kind of thought experiment. What if you had a US Treasury bill and you expected it to yield 6%, and at the same time you had the US stock market expecting to yield 6%? Well, if you looked at that and you know that the market is a lot riskier than treasuries, in that kind of a world, not too many people would want to own the market, given that the expected return of a risky asset was much higher. If no one wants to hold the market, that depresses the market price, and that will cause the expected return of the market to rise. At the same time, if everybody wants to hold the treasury and they build up the treasury, that causes the expected return of the treasury to fall. And the spread then that has arisen because of risk is a premium for bearing the risk of the market relative to the treasury bill. So we know this is the equity risk premium. We're very familiar with it. We all know equity is riskier than treasury securities, and you should expect a premium for investing in equity. So that's the simplest explanation of a factor. It turns out that you can talk about just about any factor in the same way. If one set of stocks is more desirable than another set of stocks, it will typically have a lower expected return, holding all else constant. So a couple of other factors that we talk about and invest is small or size. That small cap stocks are riskier than large cap stocks, and we may expect a premium for that. And then one that's a little less risk-based, but more behavioral-based is a factor called momentum, which is that stocks that have recently done well have tended to outperform stocks that have recently done poorly. So those are just two kind of basic examples of a factor. There are many factors in the literature. One of the famous researchers from Duke University, Campbell Harvey, cataloged in excess of 200 different factors in the literature and settled upon, he did what's known as a meta-analysis, looking at all the different research, and settled on about 5 or 6 of them that were the most compelling. So the first is that market factor that we talked about. So historically, the market, you could think about it as being the Russell 3000, has outperformed treasuries by about 6% per year, which is a pretty sizable premium. We all know that the market doesn't outperform treasuries every year. We know that in expectation or in the long run, we would expect equities to outperform treasury bills. Value is another factor that we utilize in our strategies, and that is the tendency of stocks that have a lower price multiple to outperform stocks that have a higher price multiple. This has been about 2% per year over the history of the US stock market on an annualized basis. What is a price multiple? You can think about a price multiple as a PE ratio. Any measure of price divided by a fundamental. So a fundamental could be earnings, could be dividends, it could be cash flow. That's the value factor. Size factor I alluded to, the tendency of small cap stocks to outperform large cap stocks. That premium, when it was first discovered, was a lot larger than 1%, the same as value. These premiums have tended to shrink through the years. There is evidence that small cap stocks in combination with other factors like value and like quality and volatility, that the factors tend to be quite effective in the small cap area. Quality, or profitability as sometimes it's known, is the tendency of higher quality or higher profitable companies to outperform lower quality companies. This is a relatively new factor in the world of factor investing. The three factors prior to quality here were first introduced in a paper in the 1990s by Gene Fama and Ken French, called the three-factor model. Quality has a much more recent discovery, if you will, in the early 2010s. Then we have momentum that I mentioned earlier, that stocks that have outperformed recently, recently is defined as the last 6 months to a year, tend to continue to outperform stocks that have recently underperformed. That's a very large premium of about 7%. One thing to take into consideration with these premiums is they don't take into account transactions costs. While you can earn the market risk premium very, very cheaply with an ETF, momentum is not as easy to attain. It has a lot of turnover and transactions costs associated with it. So certainly the premium that you would expect could be less than 7%. Now, we're multi-factor investors, so we try to look at these factors simultaneously. One of the analogies I like is to think about the way Warren Buffett tends to invest. And while Warren Buffett tends to invest based on these factors, but looking at individual securities, the strategies that we adopt at Symmetry and Eide Bailly do it on a systematic basis. And so what do I mean by that? Buffett likes to invest in securities that are low priced, that's value, that have high earnings and strong balance sheets, that's quality, and companies that are recently done well, that's momentum, right? And of course, he's investing in equity. So you could think about what kind of companies do you want to earn? Companies that are fairly priced or even underpriced, companies that have strong balance sheets and strong earnings, and companies that are recently doing well. And we're doing that in a systematic manner across equity markets. Low volatility is a factor in the way we've described it before, but it's a little different because it doesn't add to expected return. But what low volatility securities do is they improve your risk-adjusted return. If you look at securities that have the highest volatility or highest price standard deviation, they tend to be the securities that perform the worst. So if you can take steps to purge those super high volatility stocks from your investment universe, then you can improve the risk-adjusted return of a portfolio.
And John, that really speaks to the fact that as investors, this is a more broad statement, but as investors, we should never consider returns or the potential return for something perhaps without thinking about risk as well. They go hand in hand. And that low volatility just kind of reminds us of it. It's not always about return. It needs to be about risk as well. And by trying to lower the volatility, one of the things we do as advisors at Eide Bailly Wealth is make the ride more consistent in our clients' portfolios, in our investors' portfolios. And one way to do that is to try to reduce the level of volatility within a portfolio.
Yeah, thanks for bringing that up, Brett. None of these equity factors are without risk, right? We all know and experience equity risk. We know that in any given year, the market could be down 40 or even 50% if you go back to 2008. But in many years, the market can be up 20, 30%. On average, we would expect it to be up about 10%, right? That's become our expectation. But there's significant risk in all of these factors. One of the nice things about doing a multi-factor portfolio is that the returns to these factors tend to be somewhat uncorrelated, right? So and sometimes even negatively correlated. So when value is doing well, sometimes momentum won't do as well, and vice versa. So that diversification among factors, both within the U.S. and across the globe, is an important consideration of factor investing as well. Fixed income factors, I'll just go through very briefly. Two major factors in fixed income are how much interest rate risk you're taking on. Longer term securities tend to have or do have higher risk than shorter term securities. There seems to be, at least out to 10 years, a compensation for that in the market. And we're all familiar with credit risk, that securities with lower credit ratings are outperformed with higher credit ratings. There's a credit premium of about 1%. There are other factors in fixed income, things having to do with, say, liquidity risk or call and duration risk, call extension characteristics. But for the most part, when we're investing in fixed income, if you own the fixed income universe, your sources of return are coming from two major sources, that is interest rate risk and credit risk. So the way we view the world as fixed income and equity investors who use factors is, on the left side, we think of the conventional way of viewing performance, and that is that you get the market return. You get that from just investing in VTI, Vanguard's Total Stock Market Index. You get it very cheap. And that if you do something different relative to that benchmark, whether you're doing fundamental analysis or technical analysis or market timing or stock picking, that generates what we know as alpha. We now know through evidence and academic research that a lot of what we previously thought was alpha that is earned by managers, including managers like Warren Buffett, can be explained by exposure to factors, the factors which we went through. So the alpha slice of returns is a lot smaller, and the factor can explain a lot of what we had previously thought of as alpha.
Yeah, John, this is one of my favorite slides that explains our philosophy. And speaking of Warren Buffett, we've heard, especially in recent times with the passing of Charlie Munger, that he credited Charlie for kind of changing that his outlook or philosophy. He got used to, in the old days, really focusing on the cheapest companies. But Charlie kind of convinced him that profitable companies, it's still at a good price, can be just as good or sometimes better. And Buffett even said that he credited Charlie for a lot of the returns that they've had. And really what he was talking about there were factors. Even when it comes to someone like him, a lot of the return is explained by the fact that he invested in specific factors, even if he didn't use that word, rather than saying, oh, this company is a great company and I'm going to load up on that and pick that, and that's why I'm going to have an outsized return. So I think it's very interesting. I love this slide.
Yeah, that's a great point, Brett. I'll call attention to a paper that I like that is done by a few of the researchers at AQR Capital. It's called Buffett's Alpha, and they did precisely what you're saying, is they took the returns of Berkshire through time, and they ran it through a factor model, and they found that the alpha that Buffett experienced over a long period of time much of it can be explained by factors. And specifically, the beta was less than 1, suggesting low volatility. There was a positive exposure to value and momentum and quality and profitability. And there was a touch of leverage employed, which we would expect in an active manager. So a really good, I like, everybody knows Buffett and everyone somewhat understands his investment philosophy. And I tend to think of ours as kind of a systematic version of what Warren Buffett does at Berkshire Hathaway or has done. So that's our background on what we're doing at Symmetry, along with the folks at Eide Bailly. At this point in the presentation, I'm going to turn to taking a look at how markets did in 2023, first broadly, and then more specifically, the Eide Bailly portfolios. So 2023 was a great year for investors, whether you're a fixed income investor or a global equity investor. That stands in stark contrast to 2022, which, if you recall, if we were talking about this a year ago, it was just a very bad year to be in equities and to be in fixed income. But in 2023, global equities were up, and they were up sharply in the U.S. The S&P 500 index was up almost 27%. The NASDAQ was up, which is technology heavy, was up over 44%. Developed markets outside the world were up nearly 18%. And emerging markets, even though they're the laggards in global equity, were still up a respectable over 10%. So a really good year for equity investors, not only in the US, but across the globe. Now, we usually think about equities and fixed income as being uncorrelated or sometimes even slightly negatively correlated. But now we have 2 years in a row where fixed income and equities moved together, right? Showed some evidence of positive correlation. Bond markets were up very strongly in 2023, especially in the fourth quarter. Not only the benchmark investment grade index being up over 5%, but high yield, those highest credit risk securities, were up quite significantly. One representative index here is showing, from Bank of America, is showing over 13% in high yield. We'll come back to this a little bit for explanations as to what the details are of those bond market returns. But suffice it to say at this point, strong gains. The Fed's been fighting inflation. I would say it's not a stretch to say that they've been successful to date. Inflation from the beginning of the year as compared to the end of the year has come down significantly, down now to below 4%. The Fed raised its Fed funds rate 4 times in the beginning of 2023. The last time was in July, and I believe there was an announcement this morning of no Fed funds increase. So the Fed has kind of taken their foot off the brake on the economy in terms of trying to slow the economy down and slow inflation down with interest rate increases. That's evidenced in the economic data. The economy is still growing. It's growing around 3%, which is not a particularly alarming rate, but it still shows strong real growth. At the same time, inflation is coming under control and the labor market stays strong. So good, strong indications of what is being touted as a soft landing being engineered by the Fed. Soft landing meaning we're able to bring inflation under control without driving the economy into a recession. Now, are we out of the woods? Not quite yet. Short-term rates are still very high as compared to long-term rates. That's known as an inverted yield curve. And inverted yield curves have in the past been precursors to recessions. So I am confident, or not confident, I'm optimistic that the Fed is going to continue to manage the economy to the soft landing. Any thoughts on the Fed's work, Brett?
Well, yeah, sure. As you alluded to, there's a decision being made today. I think it's out right around now. Actually, it's usually 10:30, 11 Pacific time. I'm on the West Coast. And they're widely expected not to raise rates. People have actually been anticipating cuts now because of what you said, John. The short-term rates are still very high. Now that inflation's come down so much, the Fed should be able to proverbially take their foot off the gas, and that should continue that should help with the soft landing if we continue to see that as the base case, or the markets do. So that's what's kind of in store going forward. And we might talk a little bit about that more toward the end of the presentation, but the market's widely expecting cuts from here on out. Some would say, and we'd probably agree, too many cuts, probably expecting more cuts than the Fed will likely do unless something happens with the economy. But that'll remain to be seen. And we do have I think a slide on it at the end.
Yeah, the final, thanks, Brett. The final point on this slide is the dollar weakened slightly against foreign currencies, nothing to be too concerned about. And it was a great year for Bitcoin. I have to admit, I don't understand where Bitcoin get its value from. I actually have some theories, but it has to do with its use for illicit activities. Rather than a store of value or a way to transact legally. But Bitcoin had a tremendous rally in 2023. We at Symmetry, and I don't believe at Eide Bailly, have endorsed in investing in Bitcoin as of this point. I guess I would just say, as an investment person, if you're going to do it, be cautious about how much you put at risk. It's an incredibly volatile asset with a lot of concentrated owners who could, should they decide to divest, really crash the price. Maybe a little bit of a longer term view of global markets. This is equities in the US to the far left and developed markets around the world in the middle set of bars, and then emerging markets to the right over different time periods. You could see the recent quarter, Q4 2023, as we discussed, was positive, as well as the entire calendar year 2023. You could see historically, comparing the 1-year returns to 5, 10, and 20 years, this was really a year of outsized returns. Good for us, good for investors. Not too sure that we should change our capital markets assumptions going forward to be increased to something that we experienced for just 1 year's time. Again, if we were looking at 2022, we would have saw the 1-year returns being quite negative and outsized as compared to 5, 10, and 20 years. What this slide shows me is, in the long term, you can count on a return to stocks, a positive return to stocks, not only in the US, but also in markets around the world. Same is true in fixed income. Little difference here that you'll see is that the 3-year numbers are negative. That is because of the terrible 2022 year. This year, 2023, certainly saw outsized performance relative to the 5, 10, and 20-year numbers. But again, the same story. There is a return to investing in fixed income that is evidenced in longer term numbers. 1 year, 2022, is dragging down that 3-year number. And I think this is a good time to talk about, what are you doing when you're investing? What's the big picture of investing? When you invest in equities and you invest in bonds, you are providing capital to companies to create value, right? That is, you are sharing in the creation of wealth that is generated by capitalism, right? There's a few ways to do that. You can be an entrepreneur and put your own capital at risk in a company. But absent that, you can do it in a diversified manner by buying stocks and bonds. So a belief in markets, a belief that capitalism creates wealth, and a desire to share in that wealth is a rationale for investing. As compared to speculating. Speculating is, I think the price is wrong. If it's too low or too high, that you'll take a position in the hopes that the price will correct itself. And that's not the way we view investing at Symmetry. We see ourselves as capitalists and providing capital to companies to create wealth, not as speculators trying to outsmart the market. So how did factors do in 2023? This is some long only factor portfolios that are or factor indexes that are well known. I've put a circle around the relevant return for 2023. And what will come out of this is that in 2023, it was not a great year for factors with the exception of quality. And we'll get into some of the reasons for that. The factors are systematic, and much of the return in the US this year was driven by a few firms, which is more of an idiosyncratic or stock specific kind of experience. All the factors are positive, right? You could see the green, they're all positive. But with the exception of quality, they all lagged the general stock market. Quality had quite a good year in excess of 36%, while the market was up somewhere around 26%.
Yeah, John, and not just lagged, but quality outperformed even the next best factor, which we're showing there says Russell 2000. That's small company stocks. Beat the next best one by more than double. I think that's very, very interesting, very telling, and we'll show you a little more about why here in a moment as well.
Yes, very true, Brett. So, what did best in 2023? We talked about that a little bit. As quality did very, very well relative to the benchmarks. With respect to EB strategy on a absolute basis, on the sector momentum, the U.S. equity and the international emerging equities all benefited from the rise in markets in general, and had quite good years. On a relative basis, they struggled a bit because of the tilt to value and the tilt to small caps, and the other factors which somewhat lagged the market. But a good year for investors on an absolute basis for sure. REITs, which are real estate investment trusts, had a difficult 2022. You could think of REITs as almost bond-like. Their returns are very sensitive to changes in long-term interest rates. They did benefit from the drop in long-term interest rates in the fourth quarter, and have recovered quite a bit in 2023. But still, 2022 was a very difficult year for commercial real estate. Probably not only from the interest rate effect, but just the general forecast for commercial real estate across the country, and particularly in cities like New York and Boston and Chicago, and Los Angeles. Fixed income, we talked about high yield was a very good place to be, and commodities was somewhat of a mixed bag. Energy prices were down. Some precious metals were up. So investing in commodities was not a great year for that. And commodities investments tend to kind of move with price level in general. If the price level's taming down, then you would expect commodity returns to not be as great. So I have spent, there's a question about Bitcoin. I don't invest in anything that I don't understand, and I have spent quite a bit of time trying to understand Bitcoin and reading the research on it. Value is generated by cash flows. I'll differentiate Bitcoin from Bitcoin doesn't generate cash flows, right? It's a electronic form of payment. I'll differentiate Bitcoin from investing in companies that use technologies related to Bitcoin, but I don't know that I would ever invest something that I can't put an expected return number on that has a volatility of 60 or 70%. So if you want to think that my opinion is uninformed, that's fine. It is just my opinion. It happens to be the opinion of a lot of other people in the market, and a lot of people disagree with it. So that's my take on Bitcoin. Thanks for the question, Michael.
Yeah, thanks, John. And I would say too, we're in a lot of ways in the same camp at Eide Bailly Wealth. We still view it as a speculation. Going back to, you framed it great at the beginning, John, an investment versus a speculation. We still view it as a speculation because we're searching for what really is the missing link. There is what is the creation of value beyond just change in price, and we're still looking for that. We haven't, just completely stopped or shut it down or said, this isn't something that we're ever going to invest in by any means. But that's really the piece that's missing. Even as the question refers to with, other asset management companies creating ETFs now that have made them more liquid. So that's kind of how we're viewing it right now. The liquidity does help, having ETFs does help. But those asset management firms, remember, they're creating those to make money on fees that they charge for having people invest in their strategies. So it's a little bit different dynamic there.
Yeah, I recall, Jamie Dimon at JP Morgan has taken a lot of heat because a few years ago he said, I don't think anybody should invest in Bitcoin. And he's kind of stuck to that, with the exception of JP Morgan is going to be an authorized participant in many of the Bitcoin ETFs that just came out. So he was getting kind of beat up about that. I don't have a problem with JP Morgan acting as an authorized participant in a market for ETFs. That's what they do. They make markets, right? That's what they do. And as far as comparing us to Fidelity, we're not Fidelity. I don't want to talk bad about Fidelity, but they don't have an investment philosophy. They sell exposures, right? They sell a lot of product. They have hundreds and hundreds of funds to fit any type of risk appetite or any type of investor. We are trying to provide you and your clients with an investment portfolio and philosophy that they can live with and help them reach their financial goals. A little bit of a different business model as compared to a Fidelity.
Yeah, great distinction, and that's very true. In some ways, it's just, at least for the time being, a mismatch between goals and risk versus return proposition. Our clients, both Symmetry's and Eide Bailly's mutual clients, most of them, probably all of them, or at least almost all of them, are entrusting us with their financial lives. So it's real money, serious money, and they don't have an interest in losing it. So especially over the long term, and we're not sure there where the cryptocurrency theme is going to land yet. We want to have conviction in it before we invest in something, as we alluded to up front. Everything we do is based on research, data, information, evidence, and we just don't have that yet on an asset class like this. So kind of pivoting here, we've got the performance of the Eide Bailly strategies up now, and you're going to start to notice a theme. We've talked about it a little bit already. What's done well, kind of that overpowering performance of the quality factor that we discussed previously. And as John said at the beginning of the discussion, we are multi-factor investors. We diversify across all of the factors. So in cases where you have one that does overwhelmingly better than all the rest in a year like this, well, in absolute terms, the strategies did very well. Every strategy had a positive return, and many of them had outsized returns relative to what we would have expected in any given year. So great performance. They struggled to keep up with some of their benchmarks that you see on the screen there. But I think it's another important distinction to look at what we call a full market cycle. So we've talked about 2022 a little bit as well. And we know what happened then. Stocks were down, bonds were down, both down at the same time, also by a magnitude that we really haven't seen on record even. Both were down double digits in 2022. And then in that environment, the Eide Bailly strategies, I think all of them, if not almost all of them, performed very well. relative to the benchmarks, relative to the overall markets. So when you put it together and look over a full market cycle, the strategies have done very well, but they're kind of designed even to be a little more consistent. We hope that they're more consistent, and that's what we've seen over the past 2 years. They don't fall as much, or at least they haven't fallen as much when the markets were down. And they may struggle to keep pace when the markets are up, especially at a torrid pace. But that's kind of the dynamic between the strategies looking backward. And in the next couple slides now, we'll look forward and give you an idea of what we expect.
Yeah, thank you. And I had mentioned earlier, and we're going to get to it, the market, especially in the U.S. this year, was very much about what is being called the Magnificent Seven or the Great Eight, which are the technology company names that we're all very familiar with. Amazon, Tesla, NVIDIA, Google, Apple, etc., Microsoft. If you had outside positions in those securities or held an index that had large positions in those individual securities, you did very, very well in 2023. They're in most quality portfolios. In fact, Brett will talk to some of the Eide Bailly portfolios that did very well, had significant positions in those Magnificent Seven. But if you're investing systematically, where you spread your investable assets across many, many, many securities, thousands of securities, and if you're all underweight those seven, you are, for reasons of, say, for a value factor, your performance is going to be hurt relative to just holding those seven stocks, obviously.
Right. So this is another Eide Bailly strategy, the Season Select, and John alluded to it a little bit. This strategy actually invests directly into an index. We sort of create our own index of stocks for clients in this strategy, and this one obviously does hold those big mega cap large companies that did so well, and so this strategy performed well. It does have a component of other factors in it, so that again, in a market where there's just a few stocks that are driving performance, it caused it to not keep up as well, whereas it did better than the market in 2022. But that's what this strategy is. And I think on the next page we have our more diversified portfolios. Again, the theme is going to be the same. Strong performance, didn't keep up as well with the markets this year, but did much better last year, at least in relative terms, because they weren't down as much. So when you take the picture over the full 2 years, pretty much all of our strategies either were in line with the markets over the last 2 years, or some of them, even significantly outperformed them, taking together both 2023 and 2022. Sorry. So I think we have another polling question coming up, and then we'll talk more about what we see going forward, and more about those valuations and the concentration of factors and things. So here's the next polling question. As we start to talk about the kind of the outlook or the look ahead, what do you think will be the primary driver of the capital markets? And we have, the Fed and interest rates. That's absolutely been the driver up to this point. It continues to be extremely important. Again, like I said, we have a decision coming today, if it hasn't already, about what the Fed might do. It's widely expected what they'll do, but they're still kind of on the forefront of the news cycle. Something we haven't talked about yet, but do actually have a slide on, is the presidential election is this year, and that usually has ramifications for markets, even if in the short term. And then, of course, those tech stocks we already mentioned. Or could be something else too. That would be my pick. Maybe I should wait till we get the answers to say that, but that's what my pick would be.
Okay, I will keep this second polling question up for a few more moments, and then we will continue. Please make sure your slides box is maximized so you're able to see the polling question. You will make your selection right on the screen, and then you'll scroll down just a bit and hit submit. Please make sure you are clicking submit after you make your selections.
Yeah, Brett, I think I'm going to go with tech stocks on this. I feel like tech stocks are very high priced and priced to perfection. Any blip in their earnings seems to drive their prices down pretty hard. They're a very large portion of the market, larger than they've been in the past. So, boy, nobody agrees with me. That's great.
Well, that was a little foreshadowing too, John, because we have, I know we know what slide is next. But I think this is very interesting. So quite a few, or at least some said not sure tech stocks was the laggard there, but really it's even between the top two, the election and the Fed. Not unexpected. That's what's been driving markets and news anyway. So not surprising there, but interesting nonetheless.
Yeah, absolutely. That's a good polling question. I enjoyed that. So I had mentioned this is the look ahead portion of the presentation. Markets in the U.S. and less so around the world, but markets in the U.S. are very expensive right now. If we view expensive from the point of view of something known as the Shiller Cape PE ratio, cyclically adjusted price to earnings ratio, which looks back over the last 10 years and comes up with a PE ratio. Right now, the PE ratio at the end of 2023 was around 33, which is quite high relative to historically. Historically, the mean has been somewhere around 16, or median has been somewhere around 16 or 17. And if we look through history, the last time we saw, other than the recent period, the last time we saw PE ratios in the market that high were in 2000, and before that in 1927, right before two very significant downturns in the market. Now, I'm not suggesting that the high PEs now mean you should get out of the market because a crash is coming. But what I am suggesting is that we could use that information to help us fine tune our expectations for future returns. So in this slide, we look at how the current environment looks relative to history for the PE ratio. So as I mentioned earlier, 33 or 34 puts us in the 10th decile in terms of priciness of markets in the United States going back to 1926. And if we look at the 10-year periods following these pricey markets, you could see that the returns are quite muted. The average realized 10-year return following a PE ratio that's this high is 1.2%, where the best return was not a great 6%, right? So you could see that the PE ratios, if you look at the patterns in this table, are indicative of future returns, which is exactly the finding that Shiller got his Nobel Prize for, right? Relating PE ratios to future performance.
Yeah, John, this is also one of my favorite tables. I think you said it perfectly when we say it's a good indicator of long-term future returns, not necessarily that a crash is coming. In fact, valuations kind of in our world are notoriously known as terrible short-term predictors of market returns, but pretty excellent long-term predictors of market returns. And this table really shows it. And by the way, in the same way that we use all of the information and research and evidence in our investment management philosophy, we also build forward-looking kind of assumptions just like these into the financial plans that we create for our clients to ensure that we have as high a confidence as possible that their goals and outcomes will be achieved the way that we build the plans. So this kind of information is built in, and even to put it more bluntly, we're expecting lower returns in the next 10 and 20 years than we've had in the past it probably will be something more like, high single digit returns, 6, 7, 8% returns on stocks, for example, instead of 10, 12, 14% returns on stocks per year, like we've seen on average over the last 3, 5, even 10 years.
And I just take that as, I mean, in general, how do you take that as, save more, invest more, and consume less in expectation of lower returns going forward. For somebody like me, who's probably only a few years away from retirement, these long-term expectations are not as important as for somebody who's 10, 20, 25 years ahead of before and retiring, because you need to have a long-term plan to meet your financial goals, right? Somebody in my situation, I've either met my financial goals or I haven't, right? Nothing's going to happen too much in the next 2-3 years that's going to change that. But I think these longer term returns are a little sobering. I've seen different estimates using different methods that puts the real return of the 60-40 somewhere around 3% real for the next 10%. So next 10 years, 3% over inflation. I think that's probably more along the lines of what Brett was suggesting, 6 or 7% nominal or 8% nominal. So it's a little bit of a sobering slide, but I think it has a message that will cause people to act in their best interest, to have a little bit more sobering expectations for returns in the coming years. So this is a slide that speaks to something, a question that's really important to us as value investors. Is those of you who have been investing in value know that it has not had a good decade. Growth stocks led by technology have outperformed value stocks. And the question that we ask ourselves is, should we expect this pattern to persist? That is, that growth will outperform value, or do we expect a normalization where value would outperform growth? So one of the things that we look at and our investment partners look at is something called the value spread. So without getting too much into the details, you could think of the value spread as being, you look at the PE ratio of the most expensive stocks as compared to the PE ratio of the least expensive stocks in terms of PE. And that difference, that spread, tells you how expensive growth is to value. And what we have in this chart is looking at that through time, up through the present, and we could see that in the US, we're at the 87th percentile, in international, the 89th percentile, and 91st in emerging markets. So in terms of the expensiveness of growth relative to value, we're at a near all-time high. The only other periods of time that had this level of disparity in the spread was back in 2009, before the great financial crisis, and then again back in 1999, before the tech bubble breaking. So what is, how do I take this? I think value is still an attractive opportunity, despite the performance of the last 5 to 10 years. If I was going to get out of value, I think it would be a terrible time to get out of value now, given this spread. Would I use this information to become more value oriented? I don't think I would, because then I would be in the realm of timing a market based on a signal, and I don't want to be market timing. I'm interested more in long-term trends. So if that spread comes back to normal, right, more like the 50th percentile, back to the middle of that graph, there's different ways that things can happen from this point going forward. We could have a really quick reversion. And to a certain extent, that's what we had in 2022, where value did very well relative to growth, even though it was in a down market. In that quick reversion, momentum is not going to pick that up, right? Because a quick reversion is bad for momentum. So we might see some benefit from value in a quick reversion, but we would be hurt from momentum. A slower reversion would be kind of the best scenario for a multi-factor investor, because you would have value doing well as we went back towards mean reversion, and momentum would have your momentum portfolios would have time to adjust to that change. No reversion and continue reversion or continue widening. Continue widening is the worst case. It means that people are willing to pay more and more and more for $1 of growth earnings, which just mean they have higher and higher expectations for the future growth of growth companies, right? Taking this to the extreme, can that go on forever? Can growth stocks get infinitely more expensive as compared to value stocks? And the answer to that is no. They must revert at some point. Now, whether they revert to the long-term mean or median is a related but different question, right? Maybe the spread, a normal spread, has changed through time, but these are highly elevated dispersions from the long-term average, and I would expect some reversion, which speaks to, I don't think it's a good time to get out of value.
Yeah, John, and I know you mentioned that widening kind of scenario might be the worst one even for growth investors, I would say, because the higher the expectations get, the more they have to deliver on those expectations to keep that going, and that's, to your point, why it can't continue forever. The burden of high expectations, if you will. So I know on the next page we talk about those large. We've talked about those large companies that did so well. This really just shows, though, that, well, last year they had a huge return, and there's 8 stocks there that we're kind of pegging, and you see the return year to date in the bottom right corner is 68%, 69%. If, again, we take that back and use the whole cycle of 22 and 23, they've actually had about the same return as the market. So what that means is they were mostly just recovering. And then on the subsequent slide, we show, again, these companies, these same companies, have very high valuations relative to the rest of the market, even though the market, as we already showed, is highly valued. So these ones have even higher valuations. So again, kind of just speaks to the point that we don't expect that to continue forever. I think we got 1 or 2 more slides, and then we'll get to that last polling question. This is a quick one, but it just, I know we said we'd talk about presidential elections. It's kind of anecdotal. It's more just of a fun one because we don't have a whole lot of data points on it, which means, the sample size is small, so that statistically it's not very relevant, but it is kind of fun, and it shows what happens when the incumbent wins and loses. And for this presidential cycle, we're really looking at the blue lines because there's a Democrat who's incumbent, and you can see that when the Democrat incumbent loses, there's some lower market outcomes versus when they win. And that's really the case no matter what, Republican or Democrat. When the incumbent wins, that's usually better for the markets than if they lose. But in the end, it really just means on average, it doesn't matter much. And I think the next slide shows that as well. There's a couple returns here that just show during presidential periods, the returns 8.7 versus non-presidential periods 7.7. There is a bit of a difference there, but it's not extremely meaningful. And I think the next one here is, Fed cycles. This just kind of takes that same kind of election story and tries to put it in the context of whether, once the Fed's done raising rates, which we believe they are, what happens? And if there's you can see the hard landing on the red, a soft landing in light blue, and then the dark blue is just all cases put together. The orange is where we are now. So, the base case seems to be for soft landing. And if we do have one, then we would expect that returns should continue to be positive from here. But again, this is a small sample size as well, so it doesn't give us a full context to say, we're pretty confident in this. It's just kind of fun to see because we normally get questions around, well, what does the election mean? What happens with the Fed? What is that going to mean? So we'll get to the last polling question here in the last minute or two. And which one do you feel is most likely? I guess I kind of answered that, or what our answer would be on that before we asked the question. But you can see the different choices you can make there.
Perfect. All right, everyone, we do have our third CPE polling question up. If you are here for CPE, please make sure your slides box is maximized. Make your selection on the screen and then scroll down and hit submit. Please make sure you are submitting your answers after you make your selection. And at that time, if you do look at the earn certification box, you should be able to view your certificate and print. You can definitely do that from there. Again, as a reminder, if you are Eide Bailly staff, please ignore that viewing and printing or downloading of your certificate. It will be added right into the Learning Center.
And while we're waiting on that, there's a couple questions that we can maybe get to. This is a good one. Does national debt have any effect on returns? And I'm curious on your thoughts, John, but from my point of view, from our point of view, I think it's not so much really. The impact there from the market perspective is not super relevant in the work that I've seen. Now that could change, if we get to a point where it becomes a major problem, then obviously that could change. But historically, it doesn't seem to have a whole lot of relevance.
I would say I would agree for the U.S., which has a tremendous economy and a tremendous untapped ability to tax economic activity. The level right now is not necessarily problematic relative to GDP. But there are certainly cases of countries where you start to have national debt levels that are multiples of their gross domestic product. For example, Greece, Italy, Portugal, Spain, where those elevated levels of interest rates have caused real problems for the government and for society, and of course for returns. So I do feel like economic rationale would be don't overspend, right? Don't spend beyond your means. I feel like there's talk of that, and I would hate to see the government to continue to expand in terms of spending and spending and spending without with abandon, because I think in the long term that's bad for any economy.
Right. It seems to not be a problem until it is one, until it gets so bad, and then it is one, and then it's a problem everywhere. So very interesting. There's another, more of a comment than a question here. Fed just announced that rates are unchanged. So as we said, that was widely expected. So they are not changing rates currently. We believe they may here coming up soon, sometime this year, if everything continues to go the way that it has gone, or if the economy gets worse, for sure. When the economy starts to fall into a recession, usually, historically anyway, the Fed's late in reacting. I don't know that that will be the case this time because they're so, they have their eye on the ball so much, but that's kind of the way that we think about that currently. So I know there were a few other questions that we didn't get to. If you'd like us to respond, to answer those through email, we're happy to do so. And thank you again for joining the presentation. Thanks very much, John. I think this was very, very informative and helpful. Appreciate it.
Thank you all. It was a pleasure to be with you this afternoon. Appreciate your attention and participation. And have a great 2024.
Awesome. Thank you, John. Thank you, Brett. Thank you to all the participants who joined us today. Also, don't forget to download your certificate, and don't forget to download the handout if you have not done so already, which is located in the related content box. And that handout will have all the slides that were presented today and also the slides that we didn't get to just yet. Thank you again for joining us, and have a great rest of your day. Bye, everyone.